Hello, everyone. Welcome back to another installment of our Lunch and Learn webinar series. I'm your host, Mayur Thaker, here today. I am an analyst and the Senior Relationship Manager here at Zacks Professional Services. And the big topic for today is what has been on the minds of many folks, both investors, asset managers, as well as policymakers alike, and that is the great inflation debate. And this is especially important as of this week after we just saw the core CPI come in extremely hot at about 5% year over year. And so that's spurring a debate as to, where we go from here. So today's webinar, the goal is to understand and take a little bit of a look under the hood, so to speak, of that CPI print and of other similar measures of inflation, and to essentially try to create a framework to understand whether this inflation is transitory, meaning temporary, or is it permanent? Is it going to be a new normal? So let's take a look at that a little bit more. We can see that right off the bat, right, what's triggering this debate in the first place? And it's something that has been, a hot topic of debate ever since the Great Recession of 2008, where, for years and years, the Fed's balance sheet has grown at a very steady state, very, very predictably, in line with GDP growth, long run. And then suddenly, since the 2008 crash and the subsequent financial crisis, the Fed's balance sheet ballooned well above its long-run trend, as you can see there. And it really hasn't slowed ever since. We saw a period of stalling, between 2014 and 2019. But now, ever since, COVID hit and, triggered that severe recession, which was induced by the shutdowns, we saw, once again, the Fed step in an unprecedented way to buy assets all across the board, from treasuries to even, corporate debt issuances, which, was the first time ever that the Fed has done that. So the idea there is that, the balance sheet has, ballooned to 7.8 trillion, which is now 36% of GDP. And so this is spurring the debate of whether this will trigger runaway inflation. And, what's driving that, right? One of the things that's, behind that is the deficit. As we can see here, that the fiscal budget deficit as a percentage of GDP has never been higher. Maybe it was higher during World War II, but you'd really have to go back almost a century to get, numbers as crazy as they are right now, where, the deficit as a percent of GDP is now hitting 15%. So that is something that is not sustainable. I think most people would agree with that. So the deficit has to be worked down in either through tightened fiscal policy, which is probably going to be unlikely, given what we know to be in the Biden administration's agenda of, increased infrastructure spending and other sources of spending. Perhaps that's mitigated a little bit by proposed tax increases, but we will see what the effect of that would be on GDP growth and what that would end up doing to deficits in the long run. So it's unlikely that deficits will be, worked down through tightened fiscal policy. And so if that's not the case, then there's really only two other options. One is that GDP has to pick up faster than government spending. And if that happens, then, tax revenues go up faster than spending does. But again, that's a little bit of a tall task as well, given how much the infrastructure bill is likely to add to the debt. And, what that might do later on, it's, still unclear as to what the effect of that would be on GDP growth. And then the third option is just that, these deficits have to be ultimately monetized by the Fed. And if that's the case, then that would potentially be inflationary. So that's what's driving this entire, conversation now. that deficits have grown to such a great extent relative to GDP that, the Fed is, kind of boxed into a corner, and that they have to ultimately step in and monetize that debt. And that's why we've seen that, ballooning balance sheet, at the Fed. And so now what's this leading to? We saw, just this week, the CPI print, came in at 5% year over year. That, basically is the hottest it's been in quite a while. And, you can also see that that's being partially driven by record high, PPI readings as well, the producer price index. So these are higher prices being paid not just by consumers, but also by producers as well in terms of their input costs. And, one of the things that's been covered widely in financial media is the soaring price of lumber. And we see that here. It's, we really would have to stretch way, way back, almost a century back, to see numbers like this. But you can see here, at least in the last 70 years, we have never seen, the lumber price jump by this much year over year. And you can see that surge there of 121%. So that's obviously turning heads because lumber is a critical input cost for housing, construction, which is a huge part of U.S. GDP. So if a major input cost is rising that dramatically, then that has spillover effects in the PPI and CPI indexes as well. However, interestingly enough, you can see here that the gross margins for industrials, and I'm using our Zacks industrial proxy here, which is the component of the S&P 500 that is purely industrials. They've actually been able to pass those cost pressures on to customers. So as you can see here, gross margins did take a hit in 2020, mainly because of a drop in revenue. But now you can see as of Q1, we're seeing a bounce back in that gross margin number. So that's despite, increasing CPI year to date and PPI year to date. So that's telling us that, companies of the S&P 500 are able to pass on these increasing input costs to their customers. So, they're not being absorbed at one point in the supply chain. They're being passed on, throughout the entire supply chain. However, there's a sort of a silver lining here, which is that not everything within the CPI is increasing. So interestingly, there's three major areas that are actually moving in the opposite direction. We can see that education and communication costs, the price index for that subsector, has actually come down in terms of year-over-year growth. It's still increasing year-over-year, but essentially it's flat right now at 0.14%. You can see that medical care costs are actually contracting at 3.4% year-over-year, and it's come way down from its peak in 2019. And you can also see that food and beverage costs are actually coming down as well, about 1%. So not everything in the CPI is coming in hot. So that begs the question is that, if we are seeing permanent inflation triggered by this radical monetary policy, then why aren't prices rising altogether? Why do we see this uneven, price increase in some areas of the economy, but not in others? We can also see that rents are falling, and this may be triggered by, local laws. So maybe this is not the best indicator of inflation because we know, municipalities and states have passed regulations, forbidding landlords from, evicting, tenants. So this, is a little bit misleading, but you can at least see that, rents have been, falling in terms of the year-over-year growth. It's still up year-over-year by about 1.8%, but that number, the growth has, come down pretty significantly from 4% right before the COVID disruption started to now 1.8%. So these are all pricing. These are all, easing pressures on consumers. in the face of rising, input costs in other areas of the economy. But it's still notable that these critical areas where, most of our expenses go are actually coming down in terms of year-over-year growth. So that's something that's notable. Also, perhaps the most important commodity of all is WTI crude oil prices. Even though they're up dramatically year to date, again, that's off of a very, very depressed base. And we saw that futures actually went negative at one point in the spot, in the the most recent contract. And so now it's bouncing back from that. But if you look at the bigger picture over the past 12 years, from the highs that we saw right before the Great Recession of 2008, the crude oil price is still in a secular downtrend. So again, the year-to-date surge is still, well below where we were, just 6, 7, 8 years ago in terms of, the price of gasoline. So again, that's something that is something we should be watching closely. But as of right now, I don't see the evidence that we're breaking out in a major way with regards to the price of crude oil, which is probably the most important input cost in the entire global economy. So we'll see where that takes us. But as of right now, there isn't enough evidence to suggest that this is, poised to break out, significantly higher. So the idea here is that economic production is the key to suppressing inflation in the long run. So inflation is a function of two possible factors, right? Demand simply outpacing supply, right? So anytime we see a major hurricane, come in the Gulf Coast, we always see the price of crude oil surge, and that's because supply is coming offline, right? If suppliers are simply not able to produce and demand does not change significantly, then we see a temporary dislocation between supply and demand, and that causes prices to rise. However, that's almost always temporary in nature, and that's where that debate is coming of whether this is transitory rather than permanent. But inflation can also come from the supply of money exceeding the demand for money. So if there's too much liquidity in the economy chasing too few goods, that can also trigger inflation, and that would be monetary inflation in nature. So what's happening with production? Let's take a look at that. We just saw what's happening with the supply of money in the earlier charts with the Fed's balance sheet. But what's happening with production, and we can see that ISM manufacturing PMI is showing extraordinary strength. We see this here, right? And we've been hitting highs that we haven't seen in quite a long time, even coming out of the Great Recession of 2008. So why are prices soaring in some sectors but not in others, right? So let's dig deeper into two specific areas of the U.S. economy where we are seeing price inflation, and that is in housing and transportation. So I'm citing an article that just came out yesterday in the Los Angeles Times. The title of that article is "Lumber is Wildly Expensive Now." And these are a couple of quotes that I just picked up from that article. And I'll just, mention the highlights here. Lumber suppliers assumed demand would plunge, and so they stalled production accordingly. Distributors followed this lead, stopped buying lumber, and sold off inventories. And the article goes on to talk about there aren't enough skilled workers or active mills to process the wood. It was just this mad catch-up to ramp everything back up, but it doesn't just work that way, said Greg Kuda, Chief Executive of Westline Capital Strategies, which specializes in lumber trading. So part of the problem is that the U.S. relies on lumber from Canadian forests, a supply that has shrunk in recent years, Apov said. In 2017, the Trump administration imposed a 24% tax on softwood lumber imported from Canada, and in response, several Canadian mills shut down. So that was actually the initial step that created some of the problems that we're still seeing in the supply chain today. So the takeaway from here is that a big part of why lumber has surged year to date is a decrease in supply. right? Lumber suppliers, lumber producers really thought that the coronavirus shutdown in 2020 would have, plunged, global demand for lumber. And so they tried to act, ahead of time and stall production so that they can, conserve resources, right? If you foresee a major recession, a major drop off in demand, then, the prudent thing to do as as a business is to act accordingly and to taper production dramatically. And when they do that, and if the exact opposite happens, which is what we saw, where in fact demand picked up quite rapidly, demand for housing and demand for construction, as more and more people within the U.S. economy are shifting towards work from home and therefore looking for better places to work from home, and therefore causing more people to buy homes or seek residential real estate. That actually had the opposite effect, which was increased demand for lumber and construction materials. So lumber mills and producers were completely unprepared for the exact opposite of what they were betting on, which is an increase in demand rather than a plunge in demand. And so because they made those, moves early on during the early part of the shutdown, it's really not that easy to just flip a switch and turn everything back on, right? And that's what, Greg Kuda was saying here. So that's why we're actually seeing a huge backlog. So within the ISM manufacturing PMI, one item is the backlog. And we can see that there is massive backlog, more backlog than we've seen in the last 20 years. So this means that there is record demand for manufacturing production. However, manufacturers are simply not able to keep up with that demand. So supply simply has not been able to keep up with demand. So that's the only way backlog, can reach these high readings is simply supply or production is not able to keep up with demand. And by the way, this is bullish for corporate revenues for the S&P 500 because, according to U.S. GAAP laws and accounting standards, companies cannot, book orders as revenue until the product or service is delivered to the end customer. And so they may be seeing huge orders. However, these orders and the payments that are associated with that, go straight to the balance sheet as a liability, right, as deferred revenue. So, this backlog is bullish for revenue growth, ultimately, if suppliers can ultimately work this down and start up production again to meet that demand. So, the backlog again is evidence that, there is huge demand that is outpacing supply in terms of the manufacturing sector of the U.S. economy. And we can see this actually if I pull up a screenshot of the press release that ISM put out when they published their most recent PMI figure. And you can see where I've highlighted this right here. Members reported that their companies and suppliers continue to struggle to meet increasing rates of demand due to coronavirus impacts, limiting availability of parts and materials, record long lead times, wide-scale shortages of critical basic materials, rising commodities prices, and difficulties in transporting products are continuing to affect all segments of the manufacturing economy. And then also worker absenteeism, short-term shutdowns due to part shortages and difficulties in filling open positions continue to be issues that limit manufacturing growth potential. So again, this is clear language to me, at least, that suggests that suppliers, producers, manufacturers are simply not up and running at capacity enough to meet the demand for these products and services right now. So again, this to me means that the rising prices that we've seen in many of these sectors, include especially for lumber, but also the other parts where we have seen increasing prices, are a function of demand outstripping supply. We can also see another major area of concern that also received widespread coverage is the global semiconductor chip shortage. So this is actually another case of dramatic supply-demand imbalance. We see this article from CNBC just recently, stating that, citing and I may be butchering this name, Falang Yinuk, Director of Industry Statistics and Economic Policy, at the Semiconductor Industry Association. They're saying that the chip shortage in the automotive industry, and due to the pandemic, and increased use of semiconductors in advanced vehicles, they're saying, the events leading to the current auto chip shortage began during the second quarter of 2020, when automakers understandably reduced production and chip prices as the virus spread across the globe. Right? So automakers anticipating a big slowdown in demand, they cut production of vehicles, and therefore their suppliers, right, the semiconductor industry, also reduced their production of chips. And so in the months that followed, demand for automotive semiconductors rallied much more quickly than most anticipated. So the supply-demand imbalance cannot be remedied with a flip of a switch. So again, just like the lumber industry, both the auto and semiconductor industries believed that there would be a big drop in demand due to the global pandemic, but in fact, the exact opposite happened, and demand actually accelerated. And so when they make these big, changes to production, it's not easy to just ramp back up very, very quickly. There is a lot of, dislocation with labor, and also ramping up their own supply chains as well. So because of this disconnect between supply and demand, we've seen, huge drop off, or increase. So again, the disruption in chip supply is leading to disruption in auto production from 40 automakers globally, saying that they are stalling their factory production even right now, despite very robust demand for their vehicles, because they're unable to procure enough chip supply. So the chip supply shortage in the auto industry today, which therefore surges the used car sales. And therefore, we're seeing a surge in used car prices. And as we can see here, a 29% jump in year-over-year percent change of used car prices. So again, this is another contributing factor to the CPI index, feeding into the increasing cost of transportation. Again, something that I believe is being triggered not by monetary inflation, but by an actual supply-demand imbalance. So there's a common underlying is the key culprit behind the majority of the price inflation. In addition to a strong bounce back in jobs and wages, right? So we're actually seeing that consumers are able, at least slightly, some of the increase in rates are able to keep up with some of that because of strong job growth. So we can see the total non-farm job growth getting back to and slightly above the long run trend, as we see in the chart above, and the year-over-year growth in the chart at the bottom. Best base in the first half of 2020, so the year-over-year growth numbers can be a little misleading, but you can see that we're coming off significantly higher year-over-year growth than even exiting the 2009 growth there. So job growth has been very, very robust. Wages have actually kept up as well, and this is something that I think is extremely important to keep an eye on, which is labor productivity. This is how GDP growth can start to increase beyond labor productivity now, hitting highs that we haven't seen since exiting the 2009 recession. The trend continue to rise throughout 2021. And this is being assisted by, increasing use of technology and other factors. So, if we see increasing job growth and we see increasing labor productivity, that is a multiplicative effect on GDP, on aggregate GDP growth. So if we see that continue, then I think we can see increasing real GDP, even in excess of that hot CPI number. And fears that people have of Fed-induced monetary inflation. So if we can see in these critical areas of transport.
Mayur, can you hear me?
Yeah.
Yeah, actually, your voice, it's actually breaking up. Again, not sure how much you can do, but just wanted to throw that out to you.
Okay.
You sound crystal clear this second.
All right. Well, let's see. I have no idea what's happening. I'm just dialed in on my regular phone line, so that shouldn't be an internet issue.
Yeah.
Okay.
It could just be a typical GoToWebinar issue.
Right. Okay. All right. Sorry about that, everybody. If you do have questions, please do enter them into the webinar panel. I'll also, you can also email them in as well. I'll show you the email address in just a second here. But we are approaching towards the end of this here, so I apologize for all the disruptions. But if you do have any questions, or if you'd like a copy of this PowerPoint, I'd be happy to send that out as well, so you can review that as well here. So these are trends that I think are very, very powerful, in terms of acting as disinflationary forces. If we do see, GDP pick up due to both job growth and labor productivity, then that bodes very well for GDP growth nominally. And if we can resolve those bottlenecks within, transport and housing and construction materials, then I think that bodes very well for real GDP growth going forward. So let's keep an eye on all of these factors here. So again, job growth plus productivity, powerful disinflationary force. Technology enables greater productivity. That's bullish for gross margins for S&P 500 companies. So let's keep an eye on those things. Also, another factor with regards to the concerns about monetary inflation, we're seeing that velocity of M2 is still not picking up in a meaningful way. You can see that it's actually negative 18% right now. It has picked up year to date, but it's still quite low. And we can compare that to the last time we had hyperinflation, which was in the late 70s, and we saw that that number is way up here at the plus 5% range. And compared to that right now, we're significantly below that. So we're not seeing any signs of life with regards to the velocity of money just yet. If we do see that pick up, that could be a threat to the thesis that I've been talking about here. And also the 10-year Treasury yields is just simply not worried yet. If we do see permanent monetary inflation pick up, then we would see nominal yields pick up here as well, like we saw in the late 70s, and we're just not seeing that yet. And if we zoom into the most recent period, year to date, yields have actually moved lower. It hit about 1.75% at the highs around early April, and we've actually moved off of that level down to 1.5% as of right now, despite the very hot CPI print this week. So that tells us that the bond market is not yet concerned about this hot inflation, read that we saw here. So I think a keen eye on what's happening with the 10-year Treasury yield is warranted. So if we see this start to taper off and stabilize, then perhaps the threat of inflation is transitory in nature. So again, the key findings in summary, we see significant inflation pressures in core CPI. That's specifically in the energy, transport, apparels, and goods sectors. However, we're seeing flat or disinflation in services, education, food, healthcare, and rent. And so because uneven inflationary pressures such as this, it indicates to me, at least, just in my personal opinion, that it's more due to specific industry-specific supply-demand imbalances rather than true, Fed-induced monetary inflation. And we see that anecdotal and empirical data suggests that there are significant production setbacks, by manufacturers and other suppliers. And so because of these supply constraints have been a common underlying theme, we are seeing, this very, very specific area of the U.S. economy seeing price inflation, but not in other areas of the economy. Money velocity remains at multi-decade lows, and U.S. economy continues to add jobs at a record pace with, record labor productivity in terms of, over the past 10 years, rising wages, and exceptional ISM manufacturing PMI. So again, production is the key to controlling inflation. And productivity is the key to increasing production rates. And we're seeing really good data in both arenas. So for all these reasons, at least as of right now, I believe that the rise in these prices will be transitory in nature. I think they should, ease in the coming quarters. It may take a few quarters, maybe even up to mid-2022, to see these numbers really taper off in terms of, the price of lumber and, other areas that we have seen huge surge. But, I think, if that is really the shelf life of, this increasing, price inflation, then I think, economic growth won't be hampered, by that. And we should see, pretty strong real GDP growth going forward here. So that wraps up our call for here today. Thank you again for attending. I was your host, Mayur Thaker. You can reach out to us anytime at zrs@zacks.com. You can follow me on Twitter and follow me on LinkedIn. And again, if you have any questions, if you would like a copy of this presentation, I'd be more than happy to send that over to you. Just send us an email to zrs@zacks.com or zat@zacks.com. You can reach us at this phone number here, and follow us on Twitter at ZATools, as well as our various websites. I'll just take a few questions here. I do see a few questions in posed here. So let me just take a look at that. Let's see.
Yeah, Mayur, since there were a lot of comments just on the lagging, of the connectivity, the first question, I'll just read it off to you, is please comment at some point, if possible, about which equity market sectors perform well in inflationary periods, except, of course, for the obvious ones related to commodities and real estate.
Yeah, it's a great question. So, the sectors that would benefit from sustained inflation would be the commodity-driven sectors. So we would see that in materials, we would see that in energy stocks, primarily those two. So essentially, companies that are on the supply side of commodities rather than the consumption side of commodities. So if we do think that inflation is here to stay, then the most bullish sectors would be energy and materials. You would also see a pickup in financials if we do see dramatically higher interest rates. So, in that case, banks would benefit from that with a steeper yield curve.
Perfect. Actually, another question I have here
in other areas.
Yeah, perfect. And in regard to some of your first slides, when you had slides of the areas of the economy that were actually lowering in prices, such as communication, I guess what are the sources of why communication costs are flat or even on the decline?
I think it's because a big part of that is also because communications are services driven. And, services are, something that did not see a significant disruption as far as like online. So anything that leverages technology, anything that can be communicated online, right? Those were the sectors that actually saw the best gains in revenue growth in 2020, and we're even seeing that continue so far in 2021. So those areas of the economy really did not see significant supply disruptions, and in fact we saw a major pickup in demand. But because they are all technology driven, those are much easier to scale rather than manufacturing. And so that's why I think that's a big contributor as to why we see very flat prices with regards to that.
Okay, great. And we have another question here. How much does the low base effect, basically from last year's pandemic, skew the high inflation readings that we see right now in April and May?
Yeah, that's definitely that's certainly a concern. I mean, that's certainly a a major point to keep an eye on. That it very low CPI that are significantly higher even compared to past recessions. So that's why the inflation hawks have a little bit of oxygen right now, because they are noticing that the trend in those sub areas of inflation are significantly higher than exiting past recessions. So we did see a low base in 2008, 2009. We saw a low base in 2000, and we saw low bases in prior recessions. And yet right now, the read is very high for those sub sectors of the CPI print, significantly higher than those past areas of coming out of recession. So that's why there's a big debate, a much bigger debate today than there were in past recessions. So I think that's something we need to keep an eye on. But as we saw here, I think the areas that are seeing the biggest gains are the ones that also have evidence of supply disruptions. And so that's why I think these are transitory inflationary pressures, but it warrants a little bit more of a keen eye to keep an eye on that.
Thank you for that. And actually, this is the last question. Do you see technology-enabled disinflation offsetting inflationary pressures overall?
I'm definitely in the camp of that. Is that something longer run? So technology is something that increases in adoption, especially during recessions, because people look for more productive and more resourceful ways to conduct business. And so I do think that the shutdown of 2020 and the ongoing pressures have actually accelerated the adoption of technology, and that's why we are seeing that labor productivity increase. So that is something that is long term very much disinflationary in my view. And so we'll see whether that those gains in technology use can actually outweigh this extraordinary action that the Fed has been taking in terms of buying up assets and inflating their balance sheet. So that remains to be seen. But yes, the presence of technology and the increasing adoption of technology will at the very least reduce what inflation would have been without that technology gaining in adoption.
Yeah, there are no other additional questions right now.
All right, well, great. Yeah, thank you. I appreciate everybody joining us here. Again, if you do have any questions later on, or if you'd like a copy of this presentation, please do email us at either of these two email addresses that you see here. And with that, we'll conclude today's session. Stay safe, everyone, and hope to see everyone again for the next one.